Hey, this is June from Turning Point Life Investment, and this video is for the week ending in June 6, 2009. Let's take a look at the market, starting with a 3-year weekly view of the S&P using SPY. Okay, so we ended another week, a rather small body candlestick indicating some sort of exhaustion, some sort of indecision made by the bulls and both by the bears as well. It's telling us that the push higher isn't getting as strong as it once did with these large, wide range candlesticks. Now we're right up here with this 50-week moving average. Even though I mentioned that eventually we will tag it, it came a lot sooner than anticipated. I would think that we would get some kind of zigzag action where we pull back and then get another push, but I guess there's a sense of urgency by traders who really want to come and tag this 50-week sooner than most people would think. As a result, we're in an overbought situation with the stochastic, and given that it's a weekly stochastic, in order for it to relieve itself out of overbought, it's going to pull back a little bit longer than we anticipate, or we will anticipate. Given that this took roughly 3 months to work out, it'll probably take the same amount of time, unless the other scenario is if this is the top of the rally and then we can start another leg down. So that's the only other scenario. Otherwise, we might get some kind of sideways pullback and then another push higher. So that's basically the two scenarios that I see: either start a new leg down or pull back and push a little bit higher. Only because we've had a good year or so of decline, so 3 months worth of rally isn't really gonna correct all of this decline right here. That's just my opinion. Okay, so jumping into a 6-month daily view, we managed to push through this previous resistance of 93. Pretty much stayed and traded above this area or within a tight range for this whole week. So this is where you have to be in sync with where the market is and respect the power of the different groups that come into the market. I estimate that the current group of traders moving into this market are the latecomers. They're putting their money to work because, well, they didn't believe in this previous rally. They were sitting on the sidelines, just watching the market go higher and higher without them. Okay. You have to understand why, because, well, most of them got scared as a result of that huge decline we had last year. So, they're a little hesitant into putting more money into this market. But, as they see that prices go higher and higher, they want to start chasing after it. They want to get a piece of the action. And as a result, that's where you get these weak last-minute pushes by the market, because they're the ones who are actually making this market go higher. Most of the institutions have already bought here, and this is where your mom and pops and your brothers and sisters, that's where they come in to start buying at this point. And usually that's probably the last leg in any rallies when those people start coming in to buy. One way you can tell is by noticing the divergence. Usually the last leg, the retailers, that's where you see the divergence in the MACD, and also by the low volume right there. So right now, as far as different levels, we need to push a little bit higher to eventually hit that 100 mark on the SPY. It seems like a very likely target. So, whether it hits it or not, we really don't know. Sometimes the market likes to cut us short just to disappoint us. Sometimes it doesn't exactly hit its target of 100 exactly. So just be wary of that. We understand that 100 is a very good likely target. Just in case if it doesn't hit it or falls short, you kind of have to prepare. So as far as trading, how do you manage to trade, or what is the best way to manage your trades? Well, you have to understand, like I mentioned, this is probably going to be the last leg push if it hasn't been the last leg already on Friday. So either you start putting your stops tighter, or start taking some profits off the table. That's what I really recommend. Because we had this huge 3.5 month of rally without any significant pullback. And usually in an uptrend, that's rather unsustainable, not really healthy. So you don't want to give up all the money that you've made right here. So that's why you kind of have to watch where your stops are. Put it closer, especially since we're starting to see signs of weakness in the current market. So as far as levels, like I said, watch for a breakout above 95, 96. If that's the case, we're probably going to hit 100. If not, watch for this 93. Any break below 93, we're probably going to come back and retest this 20-day moving average, possibly even the 50-day. But 88 will be the ultimate level to to be watching out for. That's where the previous two support was. So a break below there will result in a lower low, which is a start to a new down leg. Okay, turning our attention to the VIX. The VIX has been rather non-participating, so to speak, for a good week or two. So it's been going sideways, and that's where you see the divergence. The market made a new high, but the VIX did not make a new low. So once again, right, we're seeing signs of weakness going on, and we've been seeing signs for quite some time now, but it just haven't showed itself yet. And also, if I were to draw this trend line, you can see how it's trading right underneath that trend line. So eventually, we're going to get a pop, whether it's up or down. That's only a matter of time. We'll get to find out. But most likely, we might get an upside pop, only because we're showing divergence right now. And if that's the case, then we can expect volatility to pick up. And usually that marks a deeper correction for the market if the VIX decides to pop up. Okay, something extra that I want to show you guys is looking at the chains. This is another way, another clue to tell you how to gauge market sentiment. So depending on your broker, how they list their chains, there's here you can see a theoretical value. So that's the theoretical value of where the option should be based on all the formulations. I believe the Black-Scholes formulation. So let's take a look at this strike price, 94 put, July 94 put. You can see how theoretically this put should be around $3. But right now the current demand or the current asking price is around $3.50. You can see there's a 50 cents difference, 50 cents more than where it should be. That tells you there's a higher demand for puts currently, at least on SPY. So that's one way to gauge where traders are putting their money. You can see on pretty much on every level of strikes, the asking price is much higher than where the theoretical price should be. So telling you a strong demand for the puts. And the opposite is true for the calls. You can see how the calls, theoretically, they should be, for example, this one around $2. This one's at $1.65. So much lower. The current demand for calls is much lower than where the theoretical price should be. Once again, telling you how traders are placing the bets, so to speak. Okay, so they're placing more bets on the puts than they are with the calls. Right? Another clue. Once again, we're market detectives, and we're here to pick up as many clues as possible and figure out what this overall picture, what the overall market wants to do. And this is only one piece of the puzzle, but sometimes having a lot of pieces really does help a lot more than having just one or two.